your 401k menu might be getting spicier. Think less two-fun salad, more chefs tasting with private equity on the side. This week, I'll translate what changed, what it could mean for your retirement, and the 5 questions to ask before you celebrate or panic. Here's the plan. I'll quickly explain what changed in Washington, break down what private equity in a 401k actually means in plain English, and then give you a no-drama checklist to protect your money. You'll leave with a clear playbook, no jargon, no 12-page prospectuses. 1. What just changed? 2 big things. First, a new executive order pushes agencies to make it easier for 401k plans to include alternative assets, like private equity, private credit, and real estate, inside the menus most of us see at work. Second, the Labor Department just pulled back an older cautionary statement that made plan sponsors extra nervous about alternatives. Translation: the policy winds just shifted in favor of giving you access. Will your plan add private markets tomorrow? Probably not. But the green lights are brighter, lawyers are slightly less terrified, and providers are hustling to package private assets for regular retirement savers. 2. What even is private equity, and why would I want it in my 401k? Private equity buys stakes in companies that aren't publicly traded, improving operations, adding debt, and hoping to sell at a profit. Fans say you get diversification beyond public stocks and bonds. A shot at an illiquidity premium, extra return for locking money up. Exposure to parts of the economy public indexes may miss. Skeptics say fees are higher, layered, and can eat a lot. Illiquidity: you can't trade these daily like an index fund. Opaque valuation: prices aren't set on an exchange. Complexity: ordinary savers shouldn't need a decoder ring to pick a retirement fund. Both sides are right about something. That's why the design matters. 3. How would this actually show up in my 401k? Important: you're not going to see a button that says buy private equity 100%. Regulators never wanted that. Instead, you'd see alternatives inside a professionally managed, diversified fund, like a target date fund, TDF, or target risk balanced fund that quietly allocates 5 to 15% to private markets, or a CIT, collective investment trust, built for 401ks, where private assets are a sleeve of a broader mix. You still choose a simple fund, your 2035 target date fund, for example. The fund manager decides how much to allocate to private assets. That way, you get diversification without DIY selection. Liquidity is managed at the fund level, and the plan fiduciaries, your employer's committee, still have to vet fees, valuations, and fit for participants. 4. Fees, the not-so-fine print. Let's talk money about money. Typical broad index funds and 401ks cost 0.02% or 10% a year. Alternatives are not that. Private strategies often layer a base management fee, plus performance fees or expense pass-throughs, plus the wrapper, CIT or fund of funds cost. What does that feel like? Imagine 2 almost identical 60/40 portfolios over 30 years. The plain vanilla index version at 0.05% all-in, a 60/30/10 version where 10% is private markets, and the blended all-in expense rises to, say, 0.45% illustrative. If both earn the same gross return, the higher fee version can end up tens of thousands behind by retirement, purely because fees compound against you. For alternatives to be worth it, they need to earn their keep after costs. That's the homework your plan and the fund manager must do. Aside with a grin. Fees are like barnacles on a boat. One won't sink you, but a colony will slow the whole voyage. Quick detour before we talk liquidity. Let's put real numbers on how fees quietly change your destination. Case study: when fees eat your future. 2 almost identical 401k portfolios start at $100,000 and run 30 years with the same 7% gross return. Portfolio A, low-cost index, total expense, 0.05%, 6.95%. Net portfolio B, diversified mix with a 10% private market sleeve, blended expense, 0.45%, 6.55%. Net future value check. A grows to the 750,626B, grows to 670,816. That's a $79 to $800 gap, created purely by fees compounding against you. No bad timing. No underperformance. Just barnacles on the boat. Takeaway: if your plan adds an alternative sleeve, it has to earn its keep after costs. Ask HR for the all-in blended expense, one number, so you're not guessing. Fees won't sink the ship in a day, but over 3 decades, they absolutely change the port you dock at. Lightning Round 5 Myths versus Facts. Myth: private equity guarantees higher returns. Fact: no guarantees. Net results vary by manager, vintage, and fees. Myth: if it's in my 401k, it must be low risk. Fact: it's vetted, not risk-free. Illiquidity and valuation lags still exist. Myth: I'll get a big shiny PE fund to click. Fact: you'll likely see a target date or balance fund that includes a small private sleeve. Myth: lower reported volatility means lower real risk. Fact: infrequent pricing can smooth the ride. Risk doesn't vanish. Myth: fees don't matter if returns are great. Fact: fees always matter. Even stars must clear the fee hurdle, consistently. Okay, numbers done. Let's get back to how these funds behave in the real world. Liquidity, pricing, and the famous J-curve. 5. Liquidity, pricing, and the J-curve. Private assets don't settle like public ETFs. They're valued less frequently, and they can't be sold instantly without penalties or, well, magic. 3 practical implications. Gates and AMP, pacing. Your diversified fund may limit flows into out of its private sleeve to keep things orderly. That's normal. Smoothing. Prices move in steps, not ticks. You'll sometimes see private sleeves look eerily calm when public markets wobble. That can help behaviorally, but it's not a free lunch. J-curve. Early in a private fund's life, returns can dip before they rise. Fees and costs hit before exits happen. In a diversified 401k fund, the manager balances vintages to soften this. 6. What are the real-world benefits and risks for you? Potential benefits, if well designed. Smoother ride, lower reported volatility can help savers stay invested. Different drivers. Returns come from company transformations, not just market multiples. Broader opportunity set. Access to growth stories before or instead of IPO. Risks you shouldn't ignore. Higher costs. If performance doesn't clear the fee hurdle, you subsidize complexity. Transparency trade-offs. You won't get tick-by-tick clarity. Mismatch risk. A fund that's too illiquid for a very young or very withdrawal-heavy plan is a design fail. Fiduciary and AMP, litigation risk. Your employer's committee must prove they did prudent homework. That reality alone can slow adoption, and it should. Caution isn't the enemy. Recklessness is. Your 5-question checklist. If your plan adds a target date or balanced option with private assets, ask HR or read the summary carefully. Allocation and AMP. Cap. What % goes to private assets, and is there a hard cap? Fees all in. What's the total expense of the fund, including underlying fees? Ask for a single blended number. Valuation and AMP. Liquidity. How often are private holdings valued? Are there gates or liquidity buffers? Benchmark and AMP. Reporting. What is this fund trying to beat, and how will it report performance? Fit for participants. Why is this appropriate for our workforce? Age, turnover, savings rate? Show me the work. If answers are vague, keep your default strategy. Low-cost index core, automatic contributions, and a target date fund without the alt sleeve. 8. Where this is likely headed, don't expect a stampede. Many plans will pilot private sleeves inside a few target date vintages or at low single-digit allocations. Early adopters will be large employers with strong governance. If regulators provide more clarity or even a safe harbor, the middle of the market will follow. If lawsuits fly, adoption slows. Meanwhile, providers will compete on cost, transparency, and design. Expect newer wrappers like CITs to be the workhorse. They're already common in big 401ks and can be cheaper than mutual fund formats. And what you can do this week, check your default. Are you in your plan's target date fund? Does it already disclose private sleeves? Nudge your savings rate. The most underrated alpha is contributing 1-2% more. Fees audit. Sort your holdings by expense ratio. If you're paying NGTO's 0.50% in a core fund, see if your plan has a cheaper equivalent. Rebalance. If markets ran, restore your target mix. Risk is a decision, not a drift. Calendar the policy dates. As new rules roll out, plans will communicate. Don't miss those emails. Light humor beat, yes, the emails. The ones you archive faster than free donuts disappear in the break room. Maybe open the next few. Private equity in 401ks is neither magic nor menace. It's a tool. In the right wrapper, with the right oversight and the right costs, it could help. In the wrong hands, it's just expensive complexity. Use the checklist, keep saving, and let your plan, not the headlines, drive your decisions. If this helped, like the video so more people find it, subscribe for weekly, plain English money breakdowns, and drop a comment. Checklist if you want the 5 questions as a one-pager. Site nudge, no freebies needed. Want today's takeaways in one place? Visit personalfinancetime.com for plain English weekly money moves you can actually use.